Gold didn't rip through new highs because the crowd suddenly discovered fear. It did it because custody just became the trade, and the people who don't do drama are quietly behaving like they don't fully trust the plumbing anymore. That's the conflict nobody wants to say out loud. The official narrative stays calm, the headlines stay polite. The talking heads keep debating rate cuts and soft landings, while the metal itself is being treated less like an investment and more like a fire exit. And the hidden mechanism most people miss is not gold supply in the ground. It's the lendable, mobilizable float in the places that keep the paper market smooth. Because when that float shrinks, spreads start speaking in a different language. And if one level holds into the first real liquidity week of the new year, the math changes fast. Now let's start with the counterpoint, because if you can't survive the strongest counter-argument, you don't deserve the thesis. The counterpoint is simple. This is just year-end thin liquidity plus a few noisy stories about tariffs, politics, and central banks. That's it. Nothing structural. A holiday tape. A couple of big orders. A breakout chase. The kind of move that looks dramatic in the moment and then fades when everyone is back at their desk. And if that's the truth, then what should happen next is also simple. The weirdness should fade first in the places where it's supposedly just logistics. The stress should relax. Delivery talk should quiet down. The cost of immediacy should come back to normal. Dealers should start offering liquidity again. Futures and spot should stop acting like they live on different planets. In other words, the market should behave like a market again. Hold that thought, because if it doesn't, then the holiday noise excuse dies on contact with reality. And that's where the real pressure starts. Because repatriation sounds like a political slogan, but in markets it's not a slogan, it's an operational choice. It's a custody choice. It's a jurisdiction choice. It's a settlement risk choice. And those choices are almost never made because someone wants attention. They're made because someone is stress testing what happens in the ugly scenarios. Not the base case, the ugly scenarios. The ones nobody wants to discuss on television because it sounds impolite. But institutions don't get paid to be polite. They get paid to be solvent. When a country, a fund, or a large allocator wants metal closer to home, the public hears they like gold, while the market hears something sharper. They want fewer links in the chain, fewer intermediaries, fewer legal jurisdictions, fewer points of failure, less reliance on other people's promises. And in a world where financial plumbing has been weaponized, sanctions, freezes, sudden rule changes, collateral haircuts, this is not paranoia. This is just incentives. That's the difference between retail emotion and institutional behavior. Retail buys because they want upside. Institutions move because they want certainty. And that's why repatriation is a louder signal than most price spikes. Price spikes can be chased, custody shifts can't be unseen, but the next detail is what flips the whole setup. Here's the hidden detail that reframes everything. Repatriation doesn't merely relocate gold, it reduces the lendable float that makes the paper market feel deep and liquid. Most people think gold supply is mines and recycling. That matters, sure, but that's not where sudden stress comes from. Sudden stress comes from what's mobilizable right now, in the places where metal is routinely leased, swapped, rehypothecated, and used as collateral to grease the machinery. There's a big difference between gold that exists and gold that is available to be used as a balancing weight in the system. Some bars are effectively untouchable, earmarked, allocated, politically sensitive, held by entities that will not lend. Some bars are there, but functionally frozen. And the market can pretend all bars are equal, right up until it needs bars on a deadline. Then the categories matter. Deliverable versus non-deliverable, mobilizable versus sentimental, tradable versus ceremonial. And when more metal shifts into the do not touch pile, paper liquidity looks fine until it doesn't. Because if this one level holds, the next domino is the spread, not the headline. So stop watching spot price like it's the whole story. In physical metals, the truth leaks out through the relationship between prices. Through the basis, the term structure, the cost of carry, the premiums that show up when someone needs metal now, not later. You can have a screaming spot chart and a calm structure, and that's usually a frothy move that can mean revert. But when the structure starts tightening, when immediacy becomes expensive, then you're watching a different beast. Because immediacy is a kind of interest rate. It's the rate the market charges you to stop trusting time. And when that rate rises, it's not because everyone got emotional. It's because someone is short metal in the wrong place on the wrong timeline. And that's the kind of pressure that turns quiet into violent with no warning. Now, how does that pressure actually transmit? This is where people get lost, so keep it clean. Gold has two lives, the physical life and the paper life. The physical life is bars, vaults, logistics, assay, insurance, chain of custody. The paper life is futures, forwards, unallocated accounts, swaps, claims on gold, exposure to gold, or promises tied to gold. In normal times, those two lives are tightly linked by arbitrage. If paper is too cheap relative to physical, someone buys paper and sells physical, or vice versa. and the gap closes. That's the idea. But arbitrage is not magic. Arbitrage is a business. It needs balance sheet, it needs financing, it needs inventory, it needs the ability to move metal through the system. And every one of those inputs becomes fragile when custody risk rises and a year-end balance sheet constraints bite. That is why the calendar matters more than the commentary, because the calendar changes what dealers are willing to carry. And that's when spreads start screaming. Here is the simple version of the mechanism that matters right now. When metal is plentiful and trust is high, holders are willing to lend it. They lease it out, earn a small return, and the market uses that flow to keep things smooth. When trust is lower, or when holders want metal closer, allocated and out of reach, less metal is available to lend. That can show up as tighter conditions in gold financing. It can show up as higher lease rates, tighter swap markets, or unusual premiums in specific venues. And then dealers who normally provide liquidity become more cautious. They're not manipulating anything. They're managing risk. If they can't confidently source bars on demand, they quote wider spreads, they offer less size, they demand more margin, they reduce the willingness to be short. And when the willingness to be short declines at the same moment price is rising, that's how a breakout turns into a squeeze. Not because of a conspiracy, because of plumbing. And plumbing problems don't announce themselves politely. They pop. You've already heard hints of this in operational reporting. Talk of longer wait times for withdrawals from major vaulting systems. Talk of metal being pulled toward venues where delivery pressure is higher. Talk of transatlantic flows that only make sense when a premium is strong enough to pay for shipping insurance and time. Those are not the kinds of stories that happen in a sleepy market. Those are the kinds of stories that happen when the system is quietly repricing where the gold is as a risk factor. And that's the part that matters. Think about the incentive structure for a second. If you were a major holder and you believe there is even a small chance of a future dispute, legal, political, operational, over access to metal stored abroad, you don't wait for the dispute. You move before it becomes controversial. Because once everyone panics, logistics get clogged and everyone is late. Institutions hate being late. So they move in the boring months. They move through committees. They move with paperwork. They move quietly. And by the time the public notices, the repositioning already changed the available float. That's why repatriation is a silent panic. It's panic without the theater. And if you want proof, you don't look for a confession. You look for symptoms. Symptom 1 is the chart itself. Yes, we start there, because price is still the scoreboard. Gold trading above $4,500 is not just another number. Round numbers become battlegrounds because of how positioning, option strikes, and human psychology cluster around them. When price holds above a big level, it changes how risk managers see the trade. It changes how underweight managers feel. It changes how trend systems act. It changes how volatility sellers behave. And it changes how dealers hedge. But the chart alone is not enough. The next detail is where the conviction comes from. Symptom 2 is the structure. If the front of the curve tightens relative to the back, that tells you immediacy is being valued. If certain spreads widen, that tells you balance sheet is scarce. If the basis behaves unusually, that tells you the link between paper and physical is under stress. You don't need to memorize jargon, just remember the principle. When the market is calm, time is cheap. When the market is stressed, time becomes expensive. And expensive time is what forces participants to act. That's where forced buying starts. Symptom 3 is the street symptom, the on-the-ground signals that show up away from the screen. Delays, rationing, tighter availability, unusual premiums for certain bars, faster drains of deliverable inventory toward delivery venues. Again, no need to invent exact numbers. The point is direction and incentive. If getting metal takes longer, that changes who can safely provide liquidity. And when liquidity providers step back, price jumps more on less volume. That's not a rumor. That's how every market behaves when depth disappears. Symptom 4 is global comparison. Gold is a global asset, but it trades through local pipes. When one region starts paying up for immediate access, metal moves. That movement is arbitrage. Arbitrage is the physics of markets. And when that physics starts pulling metal across oceans, it's telling you something about urgency. Because shipping gold is not like shipping memes. It costs money, it takes time, it takes compliance, it takes insurance. People don't do it because they're bored. They do it because the spread makes it rational. And if the spread makes it rational, then something in the system is tight enough to pay for friction. And friction is where price discovery changes. Symptom 5 is institutional behavior, especially from the quietest buyers of all, central banks and long-horizon reserve managers. They don't buy because they want a trade of the week. They buy because they're diversifying away from assets that can be frozen, diluted, or politically pressured. In recent years, reported central bank buying has remained significant, hundreds of tons net over the year, despite volatility and despite higher prices. That matters because it a structural drain into hands that don't flip on a headline. It doesn't need to be a stampede. A steady drain is enough when the lendable float is already shrinking. That's the reflexivity. The more metal leaves the available pool, the more the cost of immediacy can rise, which forces more cautious behavior from liquidity providers, which makes spikes more violent, which reinforces the desire for self-custody. It feeds itself, but that's not the part that matters most. The part that matters is the calendar trigger. Year-end and early January are the most underappreciated catalysts in metals because the market isn't just a crowd. It has a network of balance sheets. Banks have reporting dates. Dealers have VAR limits. Funds have performance windows. Inventories get marked. Capital gets allocated. And into that you add a thinner liquidity because desks are staffed lighter. That's why you get gaps. That's why you get sudden air pockets. That's why a level can break and not immediately retest in a clean, polite way. And when a market is already dealing with custody stress and mobilizable float questions, year-end doesn't create the problem. It exposes it. It turns a small friction into a price event. And the next detail is what flips the whole setup: options and hedging. You don't have to be an options nerd to understand the key point. Dealers hedge. When a lot of calls are bought at certain strikes, dealers who sold those calls often need to buy underlying as price rises to stay hedged. That's delta hedging. If the market moves into zones where hedging flows accelerate, price action can become self-reinforcing. That S-gamma dynamics in plain English. Rising price creates hedging demand, which can push price higher, which creates more hedging demand. In a deep market, that's manageable. In a thin market with cautious liquidity providers, it can feel like a squeeze. And when you add the physical paper link being less elastic because sourcing bars feels harder, then dealers are even less willing to be the shock absorber. So the move becomes sharper. This is not magic. This is mechanical, and mechanical moves don't care what you believe. They only care what you must do. Now let's talk about the repatriation pressure itself, because people treat it like a meme, Germany, Italy, whoever, like it's just politics. But even when political groups make noise, the underlying reason it resonates is that the public has learned something the hard way over the last decade. Rules can change. Assets can be frozen. Access can become conditional. And in a world of sanctions and geopolitical fragmentation, storing strategic reserves abroad becomes a topic again. Not always because something is about to happen tomorrow, but because the probability distribution shifted. Institutions are not paid to assume the world stays polite. They're paid to survive the tails, and gold is a tail asset not because it's shiny, but because it's a bearer asset with no counterparty risk when held properly. That's the key phrase, when held properly, which brings us right back to custody. And that's why repatriation is not a sideshow, it's a signal. But let us be honest, none of this means gold goes up forever, or gold can hit a crash. It absolutely can whip around violently, even if the long-term thesis is right. In fact, the more people lean into a narrative, the more the market uses volatility to punish them. That's the viewer psychology shield you need because the market loves one trick. It shakes you out of a good thesis with bad timing. It does it with a sudden slam that feels like the end of the world right before the move resumes, or it does it with a face-ripping rally that makes you chase right before a pullback. And both outcomes serve the same purpose: transfer position from impatient hands to disciplined hands. Your job is not to predict every tick. Your job is to separate trend signal from noise and to know what would invalidate the thesis so you don't turn conviction into denial. Because if you don't define invalidation, the market will define it for you, with pain. So, what's the clean thesis here? The thesis is not everyone is panicking. The thesis is custody preference and mobilizable float are tightening the physical paper link. At the same time, the calendar is forcing balance sheets to be more selective, and that combination increases the probability of sharp upside continuation or violent shakeouts around key levels. Translation: volatility is not a bug, it's the mechanism. And the next detail is what you should watch to know if this is real: the cost of immediacy. That cost of immediacy shows up in multiple places, so you don't have to rely on one indicator. That's proof stacking. One layer is futures versus spot behavior, how much the market is paying for near-term exposure versus later exposure. Another layer is the behavior of spreads tied to delivery venues, including the incentives that pull metal towards certain warehouses. Another layer is operational signals like withdrawal timelines and availability chatter. Another layer is institutional flow, ETFs, central bank accumulation, and reserve language. Another layer is macro, the credibility of currency regimes and policy stability. You don't need all layers screaming at once. You just need enough layers pointing the same direction to treat it as a regime shift rather than a one-day wonder. And right now, the direction is clear. The market is paying more attention to where the metal is than it did when everything felt stable. That's a regime change. Now, let's connect it to macro without turning this into a history lecture. Gold has always been sensitive to real rates, currency confidence, and geopolitical fragmentation. But the modern twist is that macro isn't just inflation prints and rate cuts. It is governance risk. It's the idea that safe is not only about default risk, it's also about political risk. When people debate whether central bank independence is being questioned, when fiscal paths feel less anchored, when currency narratives become campaign material, reserve managers notice. And reserve managers don't need to predict tomorrow's CPI. They need to manage decades of purchasing power and liquidity under uncertain regimes. That's why gold's bid can persist even when the narrative shifts week to week. Because the bid is not purely speculative. It's structural diversification. And structural bids don't care about your timeline. That is why the market can feel like it, as ignoring prim common sense for longer than you think. But that's not the part that matters. The part that matters is what happens next week. Because markets don't move in essays. They move in deadlines, delivery windows, option expiries, month-end rebalancing, quarter-end reporting, year-end risk limits. When those deadlines collide with tightening float, the move can accelerate. And if it doesn't, that tells you something too. This is where we get practical. Here's the roadmap, and keep it brutally simple. And in risk management, low probability times, high impact is still worth hedging. Gold held domestically, allocated, with clear chain of custody is a hedge against the tail where promises get messy. That doesn't mean the tail happens tomorrow. It means the tail is no longer unthinkable. And when enough institutions behave that way, the market structure changes, whether you like it or not. And here's the part the mainstream misses. This behavior can happen even if inflation falls, even if rates are cut, even if the economy soft lands. Because this is not just an inflation hedge trade. It's a trust trade. It's a sovereignty trade. It's a settlement trade. And that's why it can persist across narratives. The market can argue about CPI while the metal is being repositioned for tail risk. Those are two different conversations. One is loud, one is real. But the next detail is what flips the whole setup. Who becomes forced to act when immediacy is priced higher? When immediacy is expensive, short positions are riskier. Not because price is high, but because delivery becomes uncertain. If you are short through instruments that can be called for delivery, your risk is not just price, it's logistics. It's sourcing, it's timing. And when that risk rises, shorts either pay up to roll, pay up to borrow, or cover. That's the margin spiral spine in another costume. The market doesn't need bad guys, it needs constraints. Constraints create forced behavior. Forced behavior creates trend. And constraints are everywhere at year-end. Banks reduce inventories. Balance sheets get trimmed. Internal risk committees get conservative. That's why even moderate demand can push price further than normal. The liquidity isn't gone. It's selective. It's expensive. It's only for the right clients. And when liquidity becomes selective, the marginal buyer sets the price with more impact. That's why you can see big moves that feel disconnected from the day's news. It's not disconnected. It's deadline driven. So what should you watch, specifically over the next 1 to 2 weeks? Watch whether $4,500 acts like support or like a trap. Watch whether pullbacks are shallow and bought quickly, or whether they slice through and stay heavy. Watch whether the market keeps rewarding immediacy, whether the structure keeps hinting that now is worth paying for. Watch for any sign that operational stress narratives fade or intensify. Watch for the tone of reserve management conversations globally. Any shift toward diversification language matters, even if it's diplomatic. And watch volatility itself. If volatility spikes on a pullback, but the market reclaims quickly, that's usually strength. If volatility spikes and reclaim attempts fail repeatedly, that's usually distribution. Same emotion on the chart, different meaning. That's why you need a framework, not a vibe. Now, let's be fair about uncertainties. There are real reasons this could cool off. If liquidity returns in January and dealers step back in confidently, spreads can normalize and the market can mean revert. If macro data surprises in a way that strengthens the dollar sharply and compresses risk assets, gold can get hit in a broad liquidation wave, even if the long-term story remains intact. If the repatriation chatter is mostly political theater with no meaningful operational follow-through, then the silent panic framing becomes less urgent. And if the move above $4,500 is purely a positioning overshoot into year-end, the market may need time to digest. None of that destroys the thesis. It just changes the near-term path. And your job is to trade the path with humility, not marry the narrative. But here is why the setup remains dangerous in a bullish way. The combination of structural buyers, custody preference, and deadline-driven liquidity constraints is exactly the recipe that produces asymmetric moves. Asymmetric means it can drift and do nothing, and then jump. It can chop and frustrate, and then gap. And that asymmetry is what breaks people psychologically. They get bored, they reduce attention, and then the move happens without them. Or they get excited, they chase, and then the shakeout happens through them. The solution is not to predict. The solution is to know what you are looking at. And what you're looking at right now is a market that is slowly shifting from price is the story to settlement is the story. When settlement becomes the story, custody becomes the story. And when custody becomes the story, repatriation is not a footnote. It's the headline nobody wants to print. Because we prefer our gold at home is a polite way of saying we are not fully confident the world stays cooperative under stress. That's not doom, that's prudence. And prudence is contagious at the institutional level. So here's the clean takeaway with no theatrics. If gold holds above $4,500 through real liquidity, the odds rise that the market is in a new regime where dips are less generous and upside bursts are more violent. If it fails and slides toward the $480 area without a fast reclaim, you should respect the possibility that the breakout was timing driven and needs a longer reset before the next leg. In both cases, expect volatility. Expect narrative whiplash. Expect people to tell you gold is overbought right before it rallies again and broken right before it reclaims. That's not analysis. That's emotional anchoring. Don't fall for it. And if you want one metric that cuts through the noise, make it the cost of immediacy, not the loudest headline, not the hottest tweet, the cost of immediacy. Because when the market starts charging more for now, it's telling you something about trust in the system's ability to deliver on time. And when trust in delivery is questioned, even quietly, the whole structure tightens. That's why repatriation is not a meme. It's a symptom. If you're still here, you're already in the minority. The group that cares about mechanisms instead of slogans, stay in that group. Compare notes, watch the structure. Don't let volatility bully you into impulse decisions. And if you want to keep this community sharp, drop what you're watching. $4,500 behavior, spread signals, or any operational tell you be noticed, so we can build a real-time checklist together instead of trading feelings.